Reviewing one's investment portfolio is important, and that's because if left unchecked, your investments can quickly deviate from its original intentions. But the real question is, how does one go about this task of reviewing an investment portfolio? Our research has put forward 8 essential steps that every investor should follow, and in this video we shall detail out the first 4 steps of this process, with steps 5 to 8 being made available in part 2 of this video. These 8 portfolio review steps, if followed, can go a long way in not only keeping your portfolio performance in line with your expectations, but in also opening up some interesting financial opportunities that were previously hidden from your sight. With that being said, let's begin with step number 1. The first step in any review process is to track down every piece of financial asset you hold and to list them in one place. That's all your mutual funds, shares in companies, fixed deposits, bonds, your LIC policies, digital gold, and even your EPF and PPF account balances. The idea here is to look at one's portfolio as a whole and not merely as individual parts. While it may sound daunting, this activity is a lot easier now with most organizations giving online access to their account holders via a website or a mobile application. So this is one part that cannot be skipped, and do ensure that you record all these values in a diary or better still in an application like Excel or Google Spreadsheets. In all honesty, setting expectations is difficult. I mean, the process is not difficult, but as it's often the case, the more scientific you try to be, the more wavered is one likely to be from the target, or at least that's my experience. So this step of your review process will be more about making expectation settings a broader exercise. In other words, a simple statement that you can look to achieve and be satisfied about. In fact, it's pretty okay if this exercise comes out as a bit arbitrary, and there are 2 approaches that one can consider. The first one is a simple risk profile based thumb rule which says if you are a conservative investor, then you estimate an 8% returns. If you are a balanced investor, then 10%, and if you are aggressive, then 12 or 13%. It's a super simple, super lazy way to classify your returns expectation on the basis of your risk tolerance limit. A second approach one can consider is the inflation plus X method, which, as the name suggests, is about adding a premium to the long-term inflation rate. For example, let's say India's long-term inflation rate is 6%. So you look at targeting a 4, 5, 6 or a 7% premium over this inflation rate. This method has shown to work pretty well over longer periods of time, and is something I personally use with most of my calculations done at inflation plus 6%. This expectation setting approach works because A, it's simple, B, it's built around real growth, that's growth above inflation, and C, it also allows me enough flexibility to design a portfolio as per my risk tolerance and skill level. Now you can use any of these 2 approaches we have put forward, or use a different method to your liking, but the point is, at this stage, do have a targeted return for your investment portfolio. The third step in your portfolio review is to know how the portfolio has performed as a whole. Again, we don't want to complicate things, and our endeavor here will be to prepare a single, simple to understand percentage that can represent your portfolio's growth over a period of time. Now, one of the bigger advantages of doing this step is that it allows investors to make comparisons with the right benchmark instead of randomly doing something like comparing with the Nifty 50. And the reason that's important is because most investors have a mix of assets in their portfolio, ranging from equities to debt to gold, and even within equities there are distinct classifications like large caps, mid caps, small caps, and international funds. In fact, let's put everything together in an example and see how far it takes us. Okay, so we start with step 1, which requires us to gather all available information and organize them in a spreadsheet. So that's all my FDs, gold, debt funds, PPF, EPF, and of course the equity funds which are further broken down into clearly defined segments. This comes to a total of 40 lakhs in our example, which is now our United State of financial assets. As expected, there is a good mix of asset classes, with large cap equity funds having a 21% weightage in the portfolio, which is closely followed by debt funds and fixed deposits at 17.5% each. Step 2 in the review process is on setting expectations, and let's say we are happy with a 10% portfolio growth. Now 10% is an arbitrary number, so at this stage we start validating our 10% expectation with the assets we have in our 40 lakh portfolio. We do this by making some growth assumptions for each of the asset classes. So large cap will grow by 12%, small cap by 15%, debt funds not much, maybe 8%, and so on. We then multiply the expected growth with the asset weightages, so that's 21.25% multiplied by 12% in the case of large cap funds, which gives us a weighted expectation of 2.55%. We do this for the rest, and the total of this gives us the portfolio's weighted expected returns, which totals up to 9.1% in this scenario. So as per the beginning of your year calculations, 9.1% is the growth you're expecting from your portfolio for the year, and not the 10% that you had previously envisaged. But since this is the beginning of the year, it does give you an opportunity to either revise your target or make some tactical moves, like changing your asset composition by, say, moving money from a fixed deposit to a balanced advantage fund. The choice is yours really, but this intervention here is really about making up your mind on how you will operate for the next 6 to 12 months, which hopefully will now be in a methodical manner without having to flim-flam your way through your investments. The last task here is something you do at the end of the year, and it is to calculate and record the actual portfolio returns. So much like how you created and computed the expected returns, the same methodology will work for the actual returns. And in our case, the actual returns of the year comes to 8.2%. Which means we have not done as well as we wanted to, but the fact that we reviewed our portfolio in an organized manner, it allows us the opportunity to compare our actual performance with the expectations, which is the entire objective of this exercise. Our experience also shows that it takes about 2 to 3 reviews to get a hang of this entire process, but once you get it, I'm pretty sure you'll start enjoying these scheduled reviews. And if you're enjoying this video right now, then do tap on to that like button, subscribe to the ETMONEY YouTube channel, and also comment on this video, as it will certainly help us with the YouTube algorithm. Now that the macro part of the portfolio review is done, let's get down to brass tacks and consider the various elements that make up a portfolio. The first step one needs to take is to divide the portfolio into a core and a satellite portfolio. Now, what do we mean by that? After studying tens of thousands of investor accounts, we've observed that a reasonably large number of investors have funds in their portfolio that, on the face of it, seem totally out of place. What I mean is, investors would have been putting money in a diversified fund or a large cap fund or a mid cap scheme, and suddenly we see that some investments have gone into a consumption fund or a ESG fund or a banking fund. Now, there is nothing wrong with this, but from a review perspective, it is important for you to know which assets are a part of your core portfolio and which ones are a part of your satellite portfolio. A core portfolio, as the name suggests, is the real stuff. These are assets that will take care of your financial well-being for the next 5, 10, 20 years, while a satellite is your experimentation or fun portfolio where you can be a little tactical and take a little more risk than what you would ideally like. However, this satellite is surely not the investment on which you'll bet your future on. So have an idea of how much money is going onto your core and satellite, and if we can proffer an opinion, your satellite portfolio should ideally not be over 15% of your assets. The next part of the constituent review is to have a better understanding of the assets or schemes you are invested in from the perspective of their benchmarks. And this is important because different assets or funds have different characteristics, and to compare them with a single benchmark is likely to give us an incorrect picture. In fact, if we go back to that table we last created, we can align every asset class against a single benchmark. For example, the large cap equity funds can be mapped to the Nifty 50, and most people do that. But getting the right benchmark for a debt fund or an international fund doesn't come in so easily. So for an international fund, you might want to do what I do and use the MSCI All Country World Index as the benchmark. And if you're hearing it for the first time, the MSCI ACWI is an index that comprises stocks in about 3,000 companies from 23 developed countries and 26 emerging markets from all around the world. So having your benchmarks is important, and of course you can freely choose a slightly different benchmark to the ones that we have used. But this step definitely needs to be done as it gives investors a basis for comparing assets and fund performance. The next step, that's sub-step 3, is about tracking the right metrics. Now in the case of mutual funds, there are bound to be multiple metrics that can be calculated and compared, but not every metric is important. Turnover rate, size of the fund, the P ratio, the fund's PB ratio are displayed on many investing platforms, but they really don't help much, and in my opinion, they end up confusing more. Instead, we want to look at those variables that matter, and since investing is largely a study of return and risk, our preference would be to follow suit and do our studies on the basis of performance and volatility. A fund's performance can be evaluated on the basis of the alpha, the Sharpe ratio, and the Sortino, while the right measures of a fund's volatility are its beta and its standard deviation. For a better understanding of what is an alpha, beta, Sharpe ratio, Sortino, and the standard deviation, do watch the video we released last month on the 6 measures of mutual fund risk. And while it is in part 2 of this portfolio review video that we'll be going deeper into the understanding and identification of the right signals, but if you're a bit impatient and want a shortcut, do look out for funds that give you a high alpha, a high Sharpe ratio, a high Sortino ratio, and don't worry much about the beta and the standard deviation. In fact, an even easier, faster, and a better shortcut will be for you to access the ratings and ranking features on the ETMONEY app and website, which does all the hard work of computing and gives you a single score on a fund after reviewing up to 16 different risk and return parameters. It's a feature that is used by tens of thousands, probably lakhs of ETMONEY investors, so do give it a shot. And this concludes part 1 of the portfolio review process, where we studied the first 4 steps in this 8-step process. We started with the importance of gathering all the information, then we devised an arbitrary yet scientific way of setting expectations. Third, we figured out how to assess and record portfolio returns. And finally, we went about the task of accurately segmenting our portfolio and identifying the available tracking metrics. The remaining 5 steps, that is steps 5 to 8, will be featured in part 2 of this video, whose link you can find in the description of this video as soon as part 2 gets released. I sure hope you like this presentation, and we look forward to you applying this content to either start off or improve your own review process. And since we are all learning here, if you find some interesting insights or a modified way of reviewing, then do share it by adding your views to the comment section of this video. Thank you for your time, and I look forward to catching up with you in another 3 days with part 2 of this video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.